Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Yesterday was the day of data with the US GDP's final estimate for the third quarter coming in at 4.9% versus the 5.2%, which was the second estimate earlier. We also had the weekly jobless claims data, which printed below market expectations. Now, what we need to understand is the context of these data points in the overall dollar narrative, and JK is the best person to take us through these. Morning, JK, please help our listeners understand yesterday's data release in the entire context.
Good morning, Swaraj. I think US GDP was the last one of the last big numbers for the year 2024, and this was the final estimate of Q3 GDP, that is July-September for US, which was now assessed at 4.9%, slightly below 5.2% that was in the second estimate. But the point is, this is note 2 points. One is this is the backward-looking data. We are already 3 months after the period for which it is estimated. Secondly, even a 4.9% growth for quarter 3, as against 5.2 earlier estimated, is well above, far above the growth which is recorded by many other countries, many other major countries. So US is growing well. There was some lower estimate of consumption from 3.6 to 3.1. That's the reason why it went down. But yes, there was some slowdown in the underlying inflation number. That probably could have led to market taking it as a dovish data. But if you look at the weekly jobless claims that came yesterday, it came below market expectation of 2,15,000 case family. It came at 2,05,000, and it was just 1,000 more than what the market was expecting. So job market is still doing well. There was one more data like Philly Fed Manufacturing Index, and that gave a very mixed picture. Mainly the forward-looking indicators like new orders and capex, they were down. Employment was in the negative territory, but prices paid were much higher. Now, overall, we had a mixed picture, but if you have to assess the US economy for the year 2024, they have done much better than many would have expected. In the context of high interest rates, almost 5.5% interest rate. First 6 to 7 months, there was a continuous increase in interest rates. So in that context, US economy has done well, and relatively other economies really have not done so well. Before we move on to the market, let's also look at some other data points. Like we had Japanese inflation number, which now shows a clear sign of cooling in November. This is in line with the global trend of inflation falling. And this is now again providing a backing for the central bank's view that price growth remains weak and therefore they need not change the interest rates. Now, consumer prices came at 2.5% from a year ago, well below the previous month of 3.8%. So this does not change any expectation higher for a change in the Japanese interest rates or the monetary policy. On the markets, of course, we had bond yields that dropped off a GDP downward revision. Again, not so significant, but market was still trying to keep with its recent trend of downward movement in the yields. The 2-year dropped to 4.3%, 10-year to 3.84, and 30-year to 3.98. All of them cycle lows. But then these were bought back, particularly in the 10-year and the 30-year. Rather the yields bounced, or bonds were sold, possibly in a profit-taking push by the large investors. Overall, I don't see much downside for the yields from here after having fallen more than 1% from the highs. As we have been saying, most Fed members are pushing back against market expectation of hefty rate hikes. And such expectation can only be realized if we see a sharp recession in the economy, and that is not evident from the data that we have been going through. Stock markets had good bounce up. They shook off the previous day's surprise sell-off and rebounded. And amid labor market and GDP data that actually took as a positive points by the market. Nasdaq says 1.3%. S&P 1%, and Dow almost as 1% as well. So it's quite logical that bulls don't give up so easily. So was the case in India also. that we had a strong bounce from the sell-off that we saw 2 days back. But on the currencies, dollar was weaker. Again, going along with the bond yields, Japanese yen almost tested 142, then euro broke 1.10, but again failed to push 1.1030. GBP was relatively weaker because there was some statement from BOE chief that the strong fall in inflation might give some room for rate cut later in the year. So this is the first time that we have heard such a statement from Bank of England official. So that kept the GBP on slightly back foot. So on the currencies, not a big movement, but it has still been with the dollar weakness trend. Now back to INR market. Rather, let's look at the stock market, which really has invited a huge flow in this year. We have had almost 9 billion of flow this year, and this is one of the largest flow ever that we have received on a on a monthly basis. So that's very significant. And as far as the year is concerned, 29 billion flow. That's again a very big number. Considering all this, one would be surprised that rupee has not really strengthened. But what is not evident because of RBI's continuous intervention at the higher level is also the strong buying that has been going on for several months from oil companies and other outflows. But I have a sense that if the flows do continue, and there are reasons to believe that it can, because US rates are coming down and India's high growth rate is confirmed, and the political situation is quite a bit of comfort for the global investors. So that there is a bout of INR strength that can come about if there is no negative risk aversion news from the global markets. So that can be expected till, of course, RBI decides to let the market have its say in determining the rupee's value. So 83 and 83.35 should cover till we see a meaningful break on either side. So that's about it. The coverage from me for just ahead of Christmas. Wishing you all a great weekend and also Merry Christmas, and enjoy the time, because I think this year most of you would have made good money, except if you're trading only in INR. All other markets have given very good opportunities and money. So enjoy the holiday period, and we will come back on 26th again with our latest update. Thank you.
Thank you, JK. And it definitely seems that markets are definitely in the mood to celebrate Christmas with all the equities and risk assets rallying. But quickly summarizing all the data points that has come out, especially from the US, if we see holistically this year, US economy has done well in the context of higher interest rate scenario. Now, Japanese inflation data was released yesterday, and that has fallen in the month of November. Now, it has provided some backing to the Japanese central bank's easing policy. Bond yields have dropped on the back of US GDP data, 10-year at a new cycle low, but we did see some profit taking, and now it seems they should start bottoming, especially from the recent Fed member commentaries being a little bit hawkish. Stock markets, as I mentioned, shook off the previous day's sell-off and bounced back strongly. Even in India, we had a strong bounce in the benchmark indices. Now, after the UK inflation data, rate cut conversation has started as BOE officials note the fall in inflation and not so great growth. For rupee also this year, we have recorded $29 billion worth of flows, but rupee has not really strengthened. Now, if the flows do continue, as GK mentioned, a bout of INR strength can emerge. All of this contingent to RBI's actions. That's it from us today. Thanks for listening. Have a very, very Merry Christmas and enjoy yourselves this long weekend. We'll see you all on Tuesday with the latest round of updates from the financial markets. Thanks for listening.